Hi, Professor Rex here. In this week's video, I'm going to focus on the two dividend stock portfolios in yellow, in which we invest additional money on the first trading day of every week. They're the Dividend-Growth portfolio, which was started in 2022 and now has an annual return of 14.63% and is beating the S&P 500. And our high-yield stock portfolio, which is an annual return of 24.79% and is also beating the S&P 500. The high-yield portfolio was started in 2023. In next week's video, we'll talk in depth about our newest portfolio, the tech stock portfolio that my accounting students and I started last year, as outlined in red, and now has an annualized return of 1.31% as tech stocks have entered a correction recently. It's our newest portfolio, and because it's 100% invested in tech stocks, it's by far our most volatile portfolio. Like our dividend stock portfolios, the tech stock portfolio is a real-world investment portfolio where I make additional investments on the first trading day of each week. So in effect, all three portfolios are accumulation portfolios, mimicking someone in their working years who is consistently adding to their investment portfolios. Next week, we'll also talk about our wide moat and capital light portfolios, which are also beating the S&P 500. As a reminder, the portfolios on the right in the light blue outline are portfolios that I started in 2003 when I was in college. These portfolios are more buy and hold portfolios with infrequent trading, so their lack of action might make for boring videos. So you can go online to read more about them if you like less frequent trading. Later in the video, I'll discuss ways to potentially boost the return of our stock portfolios, but it will require giving up some portfolio diversification. But depending on how much diversification you require, that might be relatively easy to do, as our Dividend-Growth stock portfolio currently has 104 holdings, our high-yield stock portfolio has 37 holdings, and our tech stock portfolio has 26 holdings. This slide is showing the portfolio value over time for our original portfolio, our Dividend-Growth portfolio. I should say our original classroom portfolio. So in our Dividend-Growth portfolio, we invest almost exclusively in Dividend-Growth stocks. As a class project in 2022, we started investing $12.50 each week into the portfolio, and it's now worth over $2,791 after 168 weeks. Each week, we take that deposit and split it up to buy 10 different dividend-paying stocks. We're buying fractional shares of stock. Each week, we re-rate the stock, so the list of top stocks fluctuates from week to week. And in August of 2023, we started a second portfolio, this time investing in high-yield dividend-paying stocks. Now the tan line on the chart shows what the portfolio value would be if we had instead put the money into a savings account. In our first year, 2022, stocks and bonds did not do well at all. As you can see, our portfolio had overall losses where the blue line falls below the tan savings account line. But the power of compounding is working in our favor, as the portfolio really took off in November 2023. And for those of you who have been asking, all three of the portfolios are now on our website, which is beatthestockmarket.com. We post the stocks we are buying in real time on Mondays when we make our weekly investments, and anytime we sell a stock, as well as information about portfolio holdings and trade confirmations. Before we talk about our dividend portfolios in depth, let's look at what happened last week and what's coming up next week. The Federal Reserve held interest rates steady at 4.25% to 4.5%, signaling patience as inflation remains sticky. Because remember, they had their FOMC meeting last week. While the central bank still expects 2 rate cuts later this year, I expect 0 rate cuts this year, but I'm not trying to time the market based on an educated guess. Timing the market is fraught with danger. The Fed also raised its inflation forecast to 2.7% above its 2% target, and economic growth projections have been downgraded to 1.7%, reflecting a slower outlook. Now, Fed Chair Jerome Powell pointed to recent Trump administration tariffs as an added layer of economic uncertainty, and the CEOs of these S&P 500 companies are definitely agreeing with that. According to Titan Global Capital, this decision shows just how uncertain the Fed's path forward really is. Cutting rates too soon could rekindle inflation, while waiting too long could squeeze economic growth further. The biggest wild card? Trade policies and global instability could make inflation harder to control, forcing Powell to hold off on rate cuts longer than the market expects. With stocks, housing, and tech all heavily reliant on interest rate trends, this standoff between inflation and growth is a high-stakes gamble. The Fed's decision reflects a market still caught between hopes of cheaper money and fears of a slowing economy, meaning volatility could be the only certainty in the months ahead. Now, the good news for those of us who are continuing to invest in the market is we are getting much better bargains than we were just a month ago. 2025 could turn out to be a lot like 2022 when we bought stocks at fantastic prices. It wasn't fun at the time, but it led to huge gains in 2023 and 2024. Now, however, on Friday, Trump indicated he might be willing to be flexible on tariffs, which, if it happens, could turn the market around on a dime, sending stock prices higher. As for next week, the Federal Reserve's favorite inflation indicator, the PCE, which stands for Personal Consumption Expenditure, will be announced, so be ready for potential volatility on that day. And volatility is not always a bad thing. It could go up a lot if inflation comes in lower than expected. Before we get into which stocks we bought last week, a lot of people have been asking me for my favorite books about investing. My two favorite books were the basis for the 3 stock screens I publish monthly on our website, which you can see on this slide. My favorite investment book is called What Works on Wall Street by Jim O'Shaughnessy, whose investment firm managed over $6.4 billion of investments when he retired. The book is the basis for 2 of the 3 stock screens I publish on my website, beatthestockmarket.com. They are the Trending Value stock screen and Consumer Staples stock screens. I update the stock screens monthly. You can also just read the book to learn how to do the screens yourself. But first of all, what is a stock screen? It's a set of criteria used to narrow down a large list of stocks to a much smaller list of stocks in which you invest in or do further analysis of them. The book examines various ways to tell if a stock is undervalued by examining simple metrics like the price to earnings ratio, also called the PE ratio, dividend yield, etc., as well as combinations of those simple metrics. And you'll find out if you read the book that's a combination of certain metrics that works the best, as shown in the Trending Value stock screen. Now, there are a lot of tables and graphs in the book, so if you're a numbers geek like me, you'll probably like it. It also talks about the history of the stock market and the psychology of investing, which is also fascinating. The other book I recommend, especially for younger investors, was written by the son of the author I just mentioned. It's called Millennial Money and is the basis for the Millennial Money stock screen that we publish monthly on our website. Of course, you can follow the book and just recreate the screen on your own. It's a much shorter book than What Works on Wall Street. I'll try to put links to the 2 books in the description of the video, but always check out your local library to see if you can check it out for free. Now, some people ask what formula we're using for our portfolio performance. So because we are investing additional funds each week into most of our model portfolios, the way to calculate portfolio performance becomes more complicated. The formula that is most commonly used to calculate portfolio performance is called XIRR, or Extended Internal Rate of Return, and we use this formula too. It's the same formula used to calculate portfolio performance in Quicken, which is the most popular personal finance software. You can see the formula at the bottom of the screen. You can calculate it by hand, but if you want to maintain your sanity, you are better off using Excel to calculate it for you, and then use Quicken software to double check it, which is what we do. Now, in this video, we talk a lot about our dividend growth portfolio and our newer high yield portfolio, which is geared more towards those nearing retirement. Now, the table at the bottom of this slide shows a portfolio comparison when both portfolios existed, because remember, the 2 portfolios were started at different times. The high yield portfolio was started in August of 2023, and the annualized return so far is 24.79%, which is higher than our dividend growth portfolio, which has an annualized return of 14.17% over the same time period. I expect the dividend growth portfolio will have the higher return over the long run, especially since the high yield portfolio has less than 1% of the portfolio in tech stocks. If an investor was solely investing in the high yield portfolio, I would think about supplementing it with some tech stocks to get additional diversification. And now would be a good time to do that since tech stock prices are down. On our website, we have ideas for technology-focused investments that provide income ranging from dividend growth stocks to closed-end funds and ETFs. Now, one reason the high yield portfolio is beating our dividend growth portfolio over the same time period might be the very fact that the high yield portfolio has very little allocated to the technology sector, which hasn't done well lately, as mentioned before. Now, remember also that the high yield portfolio has only existed for 19 months, so its annual return will likely jump up or down to a greater extent than our dividend growth portfolio's return. And for that matter, our tech stock portfolio has an even shorter history, which is why its performance has varied the most. A very popular exchange-traded fund that only holds dividend stocks is called the Schwab U.S. Dividend Equity ETF, ticker symbol SCHD. SCHD is a large holding in my personal accounts, so I've been tracking SCHD's performance closely with our two dividend-paying stock portfolios. As of today, as of Friday, I should say, our dividend growth classroom stock portfolio's annual return is 14.63%. If we'd instead invested the same exact amounts into SCHD on the same days, the portfolio's return would only be 8.6%, a difference of 69%. Our high yield portfolio is also outperforming SCHD, but by an even larger amount. Obviously, there's no guarantee that our portfolio will keep outperforming SCHD at such a high rate, but I've been gradually selling off my personal SCHD holdings and reinvesting in our two dividend-paying classroom stock portfolios. Now, this slide shows our best performing stocks for our original portfolio, the Dividend Growth stock portfolio, based on when they were initially purchased. Stocks in yellow have been sold. Evercore, an investment bank, is in first place with a 252.9% return in a little over 2 years. Broadcom is second with a 246.7% return. The fastest risers that are still in the portfolio are Bank of New York Mellon, which has more than doubled in 17 months, and good old boring WK Kellogg, which is up over 69% in 16 months. And remember that total return includes both the dividends the company has paid as well as the increase in the stock price. Now let's talk about the strategy column. The category called Dividend Growth stocks, that's where about 89% of our investments made in this portfolio were made in these Dividend Growth stocks. What's a Dividend Growth stock? It means that they are high quality stocks with a great track record of increasing their dividend payouts to investors. The other 11% of investments so far have been made in usually smaller, under-the-radar companies that have recently started paying a dividend. These under-the-radar dividend-paying stocks tend to be riskier because they are usually smaller companies, but studies shown that they historically beat the market averages by a significant amount. This slide shows our best performing dividend stocks this past week. It does not include dividends. The best performers were Domino's Pizza, 8.4%, Darden Restaurants, GE, Vernova, Dollar General, Chevron, Sony, Clear Secure, Golden Entertainment, Goldman Sachs, State Street, Lamb Weston, and Morgan Stanley. Here's a usual disclaimer. This presentation is for informational purposes only and is not a recommendation to buy or sell securities or engage in any investment activity. It's all well and fine to get investment ideas from others, but you always need to do your own research. Now on to stocks we purchased last week. 90% of our portfolio, technically 89% of our portfolio, is comprised of high-quality dividend growth stocks, but the other 10%, or 11%, is invested in under-the-radar dividend payers. Under-the-radar dividend payers are companies that have recently started paying a dividend. Now, last Monday, we added to two under-the-radar dividend payers, Meta and Nvidia. Meta started paying their very first dividends relatively recently and appears to be undervalued in the communication sector. Our dividend growth portfolio is underweight the communication sector when compared to the S&P 500, and I want to boost the allocation to that sector. We also made an additional investment in Nvidia after the stock's price pulled back due to the DeepSeek announcement. That's a Chinese AI group. Nvidia definitely does not pay a large dividend yield, nor does it grow its dividend at a high rate, but with its high margins, profit margins, and high levels of cash flow, it could definitely become a strong dividend grower in the future. Now, if you want to do your own research on companies that have recently initiated a dividend, these are the under-the-radar dividend payers, here's a good place to start. These companies have all recently announced they will start paying a dividend. Studies have shown that companies that either start a dividend or raise their current dividend significantly outperform those that do not pay a dividend. Many of these are smaller companies and therefore have greater risk, but also greater potential. It will be interesting to see which of these companies will become dividend growers in the future. Our biggest success in this category of stocks is F&G Annuities and Repositrac, both of which basically doubled in the 12 months that we held the stocks. Now, a new one this week is Millrose Properties, which initiated its first ever dividend, and also National Cinemedia, which restarted its dividend after suspending it in 2022. So if you're good at analyzing smaller companies, this could be a really good place for you to start. Now let's talk about the dividend growth stocks we bought last Monday. I posted these rankings to our website, beatthestockmarket.com, last Monday, and then we purchased the top 10 of these 15. On this slide are my ratings for the top 15 dividend-paying stocks this past week. And we purchased the first 10 stocks on the list that are not in the yellow highlight. Stocks in the yellow highlight, in this case Microsoft, have already grown to be 4% or more of the portfolio, so we did not invest more in Microsoft last week because we want to build a more diversified, less risky portfolio. We don't want to get one or two huge holdings and be top heavy in our portfolio allocation. Remember, also we use many criteria to filter stocks, and if a stock is hovering near a required level, they may make the list one week and then drop off the list based on a small movement in that criteria. Examples of criteria used to filter out stocks include required margin of safety and consensus earnings growth estimates over the next 12 months, which changes frequently. Now, for consensus earnings growth estimates, I will only purchase a stock if its earnings are forecast to grow at least 5% over the next 12 months. That's because we want to invest in stocks that can continue to increase their dividends. So a stock might have a 5.2% estimate one week and make the list, but the next week its estimate could dip to 4.9%, which means it does not make that 5% level requirement, so it would drop off the list. This is just one of the many filtering criteria we use to narrow down our list of investable stocks. So each week we buy 10 stocks, and since we're investing such a small amount each week, it means we're buying fractional shares of these stocks. And for those that have asked, we do not automatically reinvest dividends into the same stock from which the dividend was paid. Instead, each week, when we're buying the 10 stocks as shown in this slide, we combine the weekly deposit with the dividends that have been paid that week and are sitting in the account as cash. We then take that combined total and split it amongst the 10 stocks that we're purchasing that week. In other words, we reinvest dividends weekly into the 10 stocks that we're purchasing that week. This table on this slide includes a company's sub-industry, how undervalued they are according to our research, their risk rating, quality grade, and dividend yield. Remember, all these stocks pay a dividend and have recently increased their dividends, and our methodology used here indicates they're likely to continue to raise their dividends. Therefore, this is a dividend growth strategy. Now remember, this dividend growth stock portfolio is in a brokerage account separate from my regular brokerage account to make tracking this strategy easier. So in my other brokerage accounts, I'm also investing in these dividend growth stocks and the high yield stock portfolio in the next few slides. Last week, I purchased over $2,900 of the stocks from both the dividend portfolios, as I'm gradually phasing out my main dividend ETF and buying these stocks instead. I'm also trying to tweak the buying strategy a bit, and when I learn more about those tweaks, I let you know in my weekly videos. On this slide, I want to show the components to our quality grade. Quality-wise, we only invest in stocks rated B- or better for this portfolio for 90% of our purchases. The other 10 or 11% so far have been invested in those usually smaller, under-the-radar companies that have recently started paying a dividend. Now, risk is the first quality component, which we mentioned on the previous slide. The next quality component is competitive advantage. Obviously, the more competitive advantages a company has, the better investment candidate they are. If you want a shortcut way to judge a company's competitive advantage, you can look at companies with wide moats. Wide moats are a rating you can find from Morningstar. And in next week's video, I'll discuss our wide moat strategy and how well that's doing so far. So far, it's new, but so far it's newer, but so far it's beating the S&P 500. But I still prefer our more in-depth quality grade and competitive advantage grade. All right. And finally, the last quality component is financial health. Oh, I skipped the management grade. So the next quality component attempts to evaluate the company's management. Our evaluation includes both management's use of capital and general decision making, but also our research dives deep into accounting data to look for red flags in the company's accounting practices. Remember, I teach accounting, and so that's a big part of our analysis here. And we also look at the quality or reliability of their reported profits, because a lot of times these publicly traded companies will fudge their numbers to try to make it look like they're making a profit or try to artificially inflate their profits. And also remember, the risk rating is comparing these stocks to other stocks, not to other investments like bonds or CDs. Now let's look at the company's dividend growth grades. Remember, historically, the best performing stocks are those that both pay a dividend and have grown their dividend recently. Ideally, you want a higher dividend, high recent dividend growth, and the best potential for future dividend growth. But that's not the way it usually works. Companies that are already paying out a higher dividend rarely have the greatest potential for the greatest growth in those dividends. This slide shows stocks or portfolios that have chosen to split their stocks. Since we keep track of every individual purchase in Excel, it's important that we have this slide to remind us to go back and adjust the purchase price, shares held, and dividends per share that we received once the stock split has occurred. And here's a look at the top 10 stocks that make up the largest portion of the dividend growth portfolio as of Friday after the market closed. Remember, our goal is to build a conservative and diversified portfolio by limiting the amount we invest into one single company. Aggressive investors might not want to limit the investment into any one stock. We'll talk more about that later. But I'm a conservative investor, therefore we temporarily stop investing in a company if they make up more than 4% of our portfolio. This leads to a less risky, more diversified portfolio. It's true that our portfolio's returns would likely be higher if we always invest in our top 10 stocks, regardless of the size of the stock's portfolio allocation. But that also creates a more concentrated and more volatile portfolio, and many investors can't psychologically stick with a volatile portfolio, as a lot of people are finding out now, and they found out in 2022, and they found out in 2020, and 2008, and 1987. Volatility often causes investors to panic and sell at the worst time possible. Our portfolio holdings are now at 104, with 89% of the weighting being in the high-quality dividend growers, and 11% of the portfolio's weight being in the under-the-radar dividend payers. We usually make far more additional investments into the dividend growers than the under-the-radar dividend payers. So far, around 100 to 105 stocks seems to be the natural limit for the portfolio, as there are only so many quality dividend-paying companies that are trading at a discount. Now, that might seem like a large number of companies to keep track of, but the spreadsheet we have developed for tracking the companies makes it obvious when to sell a company once we download company financial and accounting information to the spreadsheet, which we do at least weekly and doesn't take that much time. The thing that took a long time was creating the spreadsheet and also learning how to use a spreadsheet. Now let's talk about our high-yield dividend-paying stock portfolio. I've had several older students who are close to retirement take my accounting classes. They are more interested in stocks with higher dividend yields and asked to start a portfolio using a strategy featuring stocks with higher yields than the stocks in our dividend growth portfolio. So in August of 2023, we started investing $12.50 each week into stocks with higher dividend payouts. The portfolio as a whole has an annual total return of 24.79%. Since the portfolio has been in existence for 19 months, that return will likely fluctuate a lot more than the return of our dividend growth portfolio, which was started 20 months earlier. Currently, the high yield portfolio's dividend yield, if you bought all the stocks today, would be 4.08%. Compared to our dividend growth stock portfolio, the companies in this portfolio likely will not grow their dividends quite as fast. Therefore, this portfolio would be more geared toward investors closer to retirement. Having said that, many stocks in the portfolio have increased their dividends, and we've been able to sell some stocks at a high price and reinvest into lower priced bargains, pushing the portfolio's yield based on the amount we've invested to 4.92%. Now, two strategies are being implemented in this portfolio, as you'll see on the next few slides. Strategy 1 emphasizes a high dividend yield over dividend growth. Strategy 2 also features stocks paying higher dividend yields, but places a bit more emphasis on recent dividend growth than Strategy 1 in an attempt to try to get the best of both worlds, that being both a high yield and dividend growth. So which one has been the better performer so far? It's Strategy 2. The average investment in Strategy 2 has provided a total return of 17.04% and has been held for an average of 214.2 days so far, which is an annualized return of 30.77% using Excel's rate function. Now, it's not likely that the portfolio could keep an annual return that high since stocks historically average 9 to 10% per year. Now let's talk about the high-yield dividend-paying stocks we bought last Monday. I posted these rankings to our website, beatthestockmarket.com, last Monday, and then we purchased the 8 stocks. And because the high-yield stock portfolio currently has less than 1% in tech stocks, for those that want to add diversification to the portfolio, I added to my site a list of technology-focused investments that provide income. with yields from less than 2%, like Microsoft, to yields as high as 10 to 12%, all of which I either currently invest in or have invested in. I'll also tell you which one is my favorite. Of course, the technology-focused investments with the higher yields, like 10 to 12%, don't have the chance to grow their distribution yields as fast as a company like Microsoft or Broadcom. There's always a trade-off, and never chase yield. One thing that's different about this higher yield strategy versus our dividend growth strategy on the previous slides is we only purchase 8 stocks a week, and we have 2 different strategies, as mentioned before. Strategy 1 emphasizes a high dividend yield over dividend growth. That's up here in red. This is perfect for investors in retirement or getting close. Strategy 2 still emphasizes high dividend yield, but places a bit more emphasis on recent dividend growth in an attempt to try to get the best of both worlds. That's down here in strategy 2 in green. Now you can see some of the companies up here in both. Now, because there are 2 different strategies, we have 4 stocks in strategy 1, 4 stocks in strategy 2, giving us 2 rankings. So each stock we take so each week we take $12.50 and split it between the 8 stocks, so each stock gets a 1/8 weighting. Both strategies still only invest in high quality stocks, meaning a quality rating of B- or better. The 4 high yield stocks we bought last week while implementing strategy 1 are Comcast, Target, State Street, and CME. And the 4 high yield stocks we bought last week while implementing strategy 2 are Comcast, PNC Financial, State Street, and Lyondell. You can see the average yield is 4.2%. Now here's a look at last Monday's ratings for competitive advantages, management, and financial health. And on this slide, we see last Monday's grade for recent dividend growth and current yield, as well as recent dividend growth history. And in the last column, you can see their grades for dividend growth potential, which will be much lower than the stocks in our dividend growth portfolio, which consists of stock with usually lower yields, but a greater potential for excellent future growth in those dividend payouts. On this slide, we're looking at our stocks that have raised their dividends recently. The holy grail of investing in dividend-paying stocks is to have the portfolio generate enough dividends to cover your annual expenses, a level I've reached despite being on a teacher salary. Historically, dividend-paying companies raise their dividends by 5 to 6% per year, which is above the historical rate of inflation. This means a stock portfolio can produce the ultimate passive income stream, that being one that increases each year above the rate of inflation. Once again, we had several dividend increases for our portfolio stocks. JP Morgan increases dividend for the 2nd time in a year, this time by 12%. Combining the 2 increases within the last 12 months, the company has increased its dividend 21.74% in the last 12 months. This is the 15th year of consecutive annual dividend increases for this dividend achiever. And you can see the definition of dividend achiever over here. It's a company that's raised dividends 10 years in a row. The best is a dividend king, which has raised its dividends 50 plus years in a row. That's pretty rare. Also, Build-A-Bear Workshop started paying a regular dividend 12 months ago, and this week announced it will raise its dividend by 10%. Applied Materials hiked quarterly dividends by 15%. This is the 8th consecutive annual dividend increase for the company. Just 2 more years until it's eligible to become a dividend achiever. Oh, and I almost forgot that Trinet Group, which started paying its first dividend a year ago, raises dividend 10% this week. And the last 22 dividend increases for the portfolio have an average of 10%. This slide shows the cumulative growth of the dividends we've received in our dividend growth stock portfolio. Dividends for the month of February increased 70.2% over the same month a year ago. This chart shows how quickly the dividends are growing in the portfolio and is a great example of the power of compound growth. Albert Einstein is widely rumored to have called compound growth the most powerful force in the universe. So why do we only invest in dividend-paying stocks in our 2 main stock portfolios? The first reason is, according to a Hartford study, over the past 50 years, dividend-paying stocks vastly outperform non-dividend-paying stocks. The total return for dividend-paying stocks has been 9.17% per year, but for non-dividend-paying stocks, average return has been much lower at 4.27%. Morningstar also recently released a report that went all the way back to 1927 and came up with the same conclusion, that being that dividend-paying stocks have a higher return and less volatility than non-dividend-paying stocks on average. That second point about having less volatility is probably even more important than the fact that dividend-paying stocks have a higher return. So why is a lower amount of volatility so important? Well, it's much easier to stick with a less volatile investing strategy. The more volatile a strategy is, the more likely you are to panic and sell at the wrong time. So why are dividend-paying stocks less volatile on average? Because most dividend-paying companies are making a profit, which is why they have excess cash to pay back to investors. As you can see on the screen, risk and volatility of dividend-paying stocks is measured by beta and standard deviation, tend to be much lower for dividend-paying stocks, and that's a good thing. And finally, on the right side of the slide, you can see that the study also showed that the best performing stocks are dividend-paying stocks that increase their dividends, which is why our classroom portfolios of dividend-paying stocks only invest in dividend-paying stocks that have increased their dividend recently. Along the same lines, BlackRock recently released a report showing that $10,000 invested in companies that increased their dividends, called Dividend-Growers, and companies that started paying their first dividend, called dividend initiators, grew to $2.6 million. That same $10,000 invested into non-dividend paying stocks only grew to $1.2 million. So investments made in stocks that raised their dividends or started paying a dividend grew more than double than if the stocks were instead made in stocks that did not pay dividends. 116.7% difference to be precise. So not only do dividend-paying stocks historically have a higher return on average than stocks that do not pay a dividend, and they have less volatility on average, they also perform better than non-dividend-paying stocks in down markets, also called bear markets, by 1 to 2% per month, not per year. This is very important because what causes investors to panic and sell at the worst time is when they see the value of their stocks plunge. But dividend-paying stocks hold up much better in down markets than non-dividend-paying stocks. This is from a report a study in the Journal of Corporate Finance. Now, the holy grail of dividend investing is having a stock portfolio that produces two things. One, a growing stream of income that produces enough income to cover your expenses, plus extra cash to cover travel, vacations, luxury purchases, etc. And two, also produces a growing stream of income that also grows faster than the rate of inflation. And dividend-paying stocks historically increase their dividends significantly higher than the rate of inflation. This means that quality dividend-paying stocks can provide a growing income stream for a lifetime. Now, this is in contrast to bonds, which do not raise their payments to bondholders. Here are two examples of stocks growing their dividend payouts over the years. The first stock is Broadcom, which just increased its dividend for the second time last year and for the 14th consecutive year. Now, I bought Broadcom, a chip maker, in 2020, just 5 years ago, for my taxable account. At the time, its yield was 5.01%, meaning that for every $100 I invested in the stock, I would receive $5.01 each year. The company has quickly grown the dividend to the point where the yield based on the original investment is now 9.14%. Of course, investors buying the stock now are not going to get that high of a yield because the stock's price has risen so much. That's why it's important to invest early and be patient. And I fully expect Broadcom to continue to increase its dividends well into the future. And if not, that's why we have constructed a diversified portfolio. That's the power of investing in quality dividend growth companies. My second example of a high-quality company with a history of raising its dividends is Home Depot. In 2003, when I was attending college, I had started a dividend stock portfolio for the investment newsletter that I had started at the time. And Home Depot was recommended for that portfolio and is still in the portfolio today. At the time, its yield was a low 0.83%, meaning for every $100 I had invested in the stock, I would receive only 83 cents a year. Seemingly not much to get excited about. But over the years, Home Depot has grown the dividend to the point where the yield, based on my original investment, is now 31.81%. And like Broadcom, while there are no guarantees, I fully expect Home Depot to continue to grow its dividend well into the future. Of course, investors buying the stock now are not going to get that high of a yield because the stock's price has risen. Again, this is why it's important to buy early and be patient. Now remember, stocks historically have a higher return than bonds and are also riskier than bonds, but you certainly won't find a bond that pays anywhere close to the yields on the original investments that these two stocks are paying. And bonds do not increase their payouts to investors like stocks can and often do. Another reason to own dividend-paying stocks is for the potential to generate up to $126,700 of tax-free income each year if you're married and filing jointly. Remember, the ultimate goal of dividend investing is growing your portfolio to a point where it generates enough income each year to live off the dividends. And because companies historically increase their dividends above the rate of inflation, you have the ultimate income stream that not only covers your expenses but grows over time. And if you're married and filing jointly, you can make up to $126,700 in qualified dividend income and pay zero federal tax on those dividends if you have no other income. That's perfect for retirees. If you're single, that amount is $63,350. Those amounts usually increase each year as the standard deduction increases and the tax brackets are adjusted. So how are those amounts calculated? First, you find the 0% tax bracket for long-term capital gains, and then find the standard deduction, which can be located in IRS Publication 505. As you can see, for 2025, the standard deduction increased in November, meaning that you can potentially earn even more tax-free income from qualified dividends than you could in the previous year. Then the final step is to take the 0% capital gains amount and add it to the standard deduction, which means we get a final amount of $126,700 that a married couple filing jointly could generate an income from qualified dividends that would be federally tax-free. So why did we choose to start investing in our model stock portfolio with only $12.50 per week, which is essentially the same as $25 per paycheck? I personally am investing a lot more than that in these dividend strategies, but for our classroom model portfolios, the main reason we started with a low weekly investment amount is because I wanted to show my accounting students you don't need much to build a diversified stock portfolio. In fact, when I was only making $11,000 per year as an enlisted member of the military before I got my degree, I started my investing journey with only $25 per paycheck. In other words, the equivalent of $12.50 per week. And because my brokerage account, Fidelity, allows me to buy as little as $1 per stock, we can quickly and easily create a diversified stock portfolio with little money. Originally, I invested $25 per paycheck into the Dividend-Growth portfolio, but found the process to be so fun that I split it up and now invest $12.50 every week. And we boost the contribution once per year by the amount of inflation to replicate the fact that people's paychecks usually increase at least by the amount of inflation. By the way, I also invest in these same stocks in my retirement portfolio and my taxable brokerage account. Another reason I started with a low investment amount per week was because one day I was wondering how much a young person, in this case a 17-year-old, needed to invest per week to accumulate $1 million at retirement. And it turns out it's only $11.74 per week. Of course, since most people's annual salary increases each year by the amount of inflation at the very least, I assumed the contributions would increase by 3% each year, which is around the historical rate of inflation. That means in the second year, it's assumed that the person invested an additional 35 cents each week for a total of $12.09 per week instead of the original $11.74 per week. For our classroom Dividend-Growth stock portfolio, in year 2, we boosted the weekly investment 82 cents for a total of $13.32 per week. In year 3, inflation wasn't as high, so we boosted the weekly investment by only 49 cents for a total of $13.81 per week. And for this year, the inflation was even lower, so we boosted the weekly investment by only 37 cents. So we now invest $14.18 on the first trading day of each week. Now let's talk about ways to potentially increase the return of our Dividend-Growth portfolio. For those that are okay with giving up some portfolio diversification, I believe there are 4 potential ways to boost the portfolio's returns. Each week we buy 10 different dividend-paying stocks ranked 1 through 10. On average, the stocks in positions 1 through 5 outperform the stocks in positions 6 through 10. Therefore, the first way to potentially boost portfolio returns is to buy only the stocks in positions 1 through 5, or maybe like 1 through 6 or 1 through 7. However, the downside is this reduces portfolio diversification. But some investors are more comfortable with a more concentrated portfolio. So far, investing in only stocks ranked 1 through 5 would have improved annual returns by 45%. But I personally prefer a more diversified portfolio since the goal of my dividend portfolio is to live off the dividends. Option number 2, you could try not limiting individual portfolio holdings to 4% of the portfolio's total value. So normally, if a stock's allocation in the portfolio is 4% or greater, I will not purchase more of that stock. This technique reduces the portfolio's risk by ensuring the portfolio does not become heavily weighted in 1 or 2 stocks. I purposely created this portfolio so it would be very diversified because the ultimate goal of dividend investing is to have the dividends cover all of your expenses, plus generate extra income for vacations, travel, etc. I'm a conservative investor and I'm personally investing a lot in these dividend portfolios. So I want to make sure the portfolio is not only well diversified between sectors, but also between industries and even sub-industries. That way, when the inevitable dividend cut happens, it doesn't affect one's cash flow in a major way. However, an investor who has a higher risk tolerance and therefore doesn't mind a more concentrated portfolio might try removing the 4% limit in an attempt to boost the portfolio's returns, especially if the company is in the top 5 of that week's rankings, as mentioned in bullet point 1. So far, not limiting individual stock positions to 4% of the portfolio would have improved the annual returns by 55%. But again, I personally prefer a more diversified portfolio. Number 3. So the under-the-radar dividend payers, despite having some incredible performers like F&G Annuities, 119% gain in 12 months, and Repositrax, 97% gain also in 12 months, on average, they've not performed quite as well as the dividend-growers in the portfolio. So skipping the under-the-radar dividend payers is an option to try to boost portfolio returns. One possible reason these stocks have not done quite as well as the dividend-growers is because many of those under-the-radar stocks are very small companies. And small stocks have not performed as well as big stocks in recent years. Like the previous strategies, this method reduces portfolio diversification. And number 4, you could try selling when a stock is fairly valued, even if the dividend and quality metrics are excellent. So we don't sell stocks often in the portfolio and tend to only sell if the company cuts a dividend or the stock appears to be overvalued or the company's dividend and quality metrics fall out of the top 50% of stocks. In other words, if a stock appears to be fairly valued, but the dividend and quality metrics are still good, we usually will not sell the stock just because it's fairly valued. But if you have your own valuation methodology and it signals that the stock is fairly valued or even overvalued, you might try selling at that time and reinvesting in that week's top 10 stocks that we're buying. The downside would be higher turnover, but this could boost your portfolio's returns by not holding on to fairly valued stocks. If you try this, I'd be very interested to hear your results. Of course, this 4th strategy is the most difficult to implement because you have to have your own valuation methodology, and then you also have to implement it on your own. And for those looking for a less hands-on approach, let's talk about some options to potentially simplify things. For our model portfolios, we invest weekly, but there's no hard and set rule that says to do that. Now, most people invest with every paycheck, meaning that most people have funds taken out of their paycheck, which is usually paid every other week, and it's automatically invested in their 401k. When I started our dividend-growth stock portfolio, I originally invested $25 every other week instead of $12.50 every week. I only switched from every other week to weekly because I found the process to be fun. Now, the advantage of investing every week, as opposed to every other week or monthly, is you get more diversification. So if one doesn't mind less diversification in their portfolio, option 1 is to invest every other week or monthly instead of weekly. Option 2 is to just buy the high-quality stocks, meaning those with a quality rating of B- or better, and hold forever. In other words, you would skip the under-the-radar dividend payers. Over time, some of those stocks will turn out to be clunkers, but they will just become very small parts of your portfolio as you let your winners run. That's it for this week. In the comments, let me know if you have any questions, and also let me know what other portfolios or investment strategies you'd like to see more of. And finally, here are the places you can reach me. YouTube, obviously, as well as our website, beatthestockmarket.com, LinkedIn, and Twitter. I'll talk to you next week with another portfolio update. See ya!